In this video, we're going to talk about margin for futures contracts. So first off, margin is cash or marketable securities, like treasury bills, for example, deposited by an investor with his or her broker. So again, in order for me as an investor to trade futures contracts, I need a broker through which I trade. So margin minimizes the possibility of a loss through default on a contract. And so it minimizes the possibility of a loss through my default. So if I don't pay my margin, then the broker could lose money. The person who's on the other side of the futures contract could lose money. Money could be lost. So margin is trying to minimize this possibility. Doesn't mean it eliminates it, but it minimizes it. So there are two key levels for margin. The first is called maintenance or variation margin. So this is an amount that if the margin level, the amount of money in the margin account falls below this amount, the investor is going to receive a margin call from their broker and must post additional margin up to the initial margin level. The initial margin is the amount of money that must be deposited at the time the contract is entered into, and currently, for the CME at least, the initial margin is set to be 110% of the maintenance margin. So the CME will publish the maintenance margin level and you can calculate the initial margin from that. Now, margin is settled on a daily basis. So at the end of every day, the margin account is adjusted to reflect the investor's gains or losses. And if the margin account holds more than the initial margin, remember 10% above the maintenance, the investor may withdraw funds down to the initial margin level. If the margin account holds less than the maintenance margin, then the investor must post additional funds to bring the level back to the initial margin, not back to the maintenance margin, but to the initial margin. And if the margin call is not met, then the broker is allowed to close out the investor's position. So let's look at an example. So let's take the Swiss franc futures contract. So this is a physically settled futures contract. The contract size is for 125,000 Swiss francs. The units for the contract are dollars per Swiss francs. And again, CHF is an ISO code. It's a 3-letter code, stands for Swiss francs. And the tick size is 0.0001 per Swiss franc increment, and that's worth $12.50. So if we take 0.0001 times 125,000 Swiss francs, we find $12.50. Okay, on January 9th, 2015, an investor takes a short position in 2 March Swiss franc futures contracts. So again, contract size is 125,000 Swiss francs. The futures price is $0.9860 per Swiss franc. The maintenance margin was $2,250 per contract, or $4,500 in total. The initial margin is 110% of the maintenance margin, so the initial margin per contract is $2,475 or $4,950 in total. Now, notice this is a fairly leveraged position. For each contract, one has to post $2,250. One has to post $2,475 in initial margin. And the contract size is 125,000 Swiss francs, so one is controlling 125,000 Swiss francs with $2,475. The exchange rate's pretty close to 1, so basically one's controlling something on the order of $125,000 with something on the order of $2,500. Okay, so now let's look at what might have happened. So they traded at 0.9860 on that, and they posted $4,950. On that first day, right, again, we trade sometime during the day, the market closes briefly, and we have a settlement price, a final settlement price of 0.9871. This is not good for our investor, right, because they're short 2 contracts. The price went up, so they lost money. How much money did they lose? We can look at the number of ticks. So 9860 to 9871, that is 11 ticks, 11 times $12.50 times 2 contracts. They lost $275. So they lost $275. That comes out of their margin. So now they have $4,675 in the margin account. If it goes below $4,500, they get a margin call. So they don't have a margin call. The next day, the price moves a little bit back in their favor to 0.9869. They make $50. That's 2 ticks. 2 times 1250 times 2 times 1250, sorry. And now their cumulative gain or loss is $225, and their margin balance goes up by $50. It's still above the maintenance margin level, so they don't have a margin call. It's below the initial margin level, so they can't take any of this money away. The next day is a good day for them. It goes to 0.9806. They make $1,575. Cumulatively $1,350. Now they've got $6,300. I'm not going to do it, but if they wanted to, they could take the $1,350 out of their margin account and put it somewhere else. I'm just going to leave it in the margin account because it's a little easier to manage the math. The next day, 0.9817, that's against them, $275 again. Now they're at $1,075. Margin balance $6,025. The next day, the market went to 111.68. That was a pretty bad day. They lost $33,775. Cumulatively, they've lost $32,700. Their margin balance is negative $27,750, and they're going to get a margin call. The margin call's not back to zero. The margin call is back to $49.50. So the margin call is $32,700. Okay, now this market, this was back in January 2015, this actually happened, right? These prices are real prices. And what happened on that fifth day was that the Swiss central bank changed policies in quite a dramatic way. And the Swiss franc strengthened. Now, the main drivers here were Swiss francs and euros. So the Swiss franc strengthened something like 20% against the euro. It was a huge move. And of course, if you were short Swiss francs, you lost a lot of money. Now, the next day, the CME raised the maintenance margin level requirement to 67.50. And of course, the initial margin is 110% of that. And we need to think here, what happens, right? What happens in this circumstance where somebody has a margin balance of negative $27,750 and a margin call of $32,700 on a position they were managing with about $5,000. So this is a pretty significant move. The investor doesn't necessarily have enough money to pay for all of this. So the investor could go bankrupt under these circumstances. Now, there are two circumstances, right, where the investor could, two things the investor could do. First, the investor could pay their broker $32,700. And if they pay their broker $32,700, then that day they will be able to maintain their position. The next day, the margin is going to go up, right? The maintenance margin goes to 67.50. The initial margin is 110% of that. What the margin balance required is 2 times the maintenance margin, because I have 2 contracts. And the initial margin is 2 times 110% of the 67.50. Now, so on this day, they would get on the day 5 here, they would get a margin call of 32,700. That would bring them back to margin balance of 49.50. The next day, that margin balance margin requirement is going to go up to about $15,000, and they're going to have to post another $10,000 in order to maintain the position. So version 1, the investor has the 32,700 and can quickly make the margin call, right? The broker calls them up, says you owe me 32,700. They post the 32,700. The position is maintained. Version 2 would be they don't have 32,700, but they've got 27,750. Well, if they pay the 27,750, they have covered all of their losses, right? Because they started with 49.50, the total losses with 32,700. They pay the 27,750 net. They've paid out 32,700. If they cover all of their losses, they haven't met the margin call. They couldn't pay 32,700, but they cover their losses. They don't make the full margin call. The broker closes out their position, and everybody goes away relatively happy. Well, this investor is not happy, but the investor on the other side of this contract is happy because they've been paid. Version 3 is the problem for the exchange, and the problem for the structure of the futures market would be that this investor has lost almost $28,000 and doesn't have the $28,000 to pay. So we need to talk about one more thing here. So the last part we need to talk about with respect to margin is the clearinghouse, the concept of a clearinghouse. So a clearinghouse acts as the intermediary for all futures contracts. So if I go long a futures contract, my counterparty is the clearinghouse. If I go short a futures contract, my counterparty is the clearinghouse. The clearinghouse is the intermediary, and there's actually another person behind the clearinghouse who's also trading with the clearinghouse. If I go long, somebody else, not the clearinghouse, but somebody else, some other investor, trader, whomever, has to go short. We are both doing our transaction with the clearinghouse. We don't know who the other one is. So the clearinghouse acts as the intermediary in all the futures contracts. It guarantees performance of both parties to each transaction. So it guarantees the performance of that person who went short and lost lots of money. It is also responsible for keeping track of all the transactions that take place in a day. But we're going to talk about this guarantee for a minute. Now, the clearinghouse has clearinghouse members. All trades must be channeled through a clearinghouse member, and clearinghouse members must post funds to the clearinghouse. The clearinghouse members for the CME, I won't go into the list. There's a whole list of them. There are lots and lots of clearinghouse members. Individuals trade futures contracts through brokers. And a broker could be a clearinghouse member, or a broker might conduct all of their business through a clearinghouse member. So let's think about margin cash flows from a broker's perspective. A broker is going to settle offsetting client positions directly. So if one person's short and one person's long, and the person who's short loses money and the person who's long makes money, the broker will take money out of the margin account for the person who's short and put it in the margin account for the person who's long. And so here is my broker's picture here. The short client effectively, they both have accounts with the broker, so this is sort of automatic, but effectively the person who's short gives money to the broker, who gives it to the person who's long. Now, the broker will have a net long or short position depending on their clients, right? Some of their clients will be long, some of their clients will be short. Net, we add all those up, and the broker will be net long or net short. The clearinghouse member will offset positions between their own clients and brokers who clear through them, right? So again, on that same trade, the person who's short lost money, the person who's long made money. These funds flow through the clearinghouse member. The clearinghouse, each clearinghouse member has a net long or short position, and these positions are settled through the clearinghouse. Same sort of idea. Now, hopefully, within a clearinghouse member, and each clearinghouse member, each broker will have offsetting positions, so their positions will be not the sum of any individual set of positions, right? Their positions will generally be smaller. Now, the clearinghouse maintains a default fund, and this is designed to cover losses if a clearinghouse member defaults. So members are required to pay into the fund when they join and further upon a default. The CME Group's default fund contains approximately $3 billion and can assess an additional $9 billion against its members if necessary. So let's go back for a second. Let's go back to the broker and think about what happens. Here's a client has lost lots of money. He can't pay. Who's responsible here to pay the person who's long? The person who's short lost lots of money. They didn't have the money to pay. The broker is responsible in the first instance to pay the person who's long. As long as the broker can afford to pay that, the system works fine, right? The broker pays the money, right? So this person who's short, let's say this person who was short lost $25,000 and just said, forget it, I don't have any money. The broker has to step in, cover the $25,000 and give it to the person who's long. And they, of course, sue the person who's short for not satisfying their obligations. So they will go back and try to recover that $25,000. But in the first instance, the broker covers. Now, if there were too many short clients at this one broker and they all lost money at the same time, they could overwhelm the broker. Well, if a broker goes bust, right, they aren't going to be able to cover the money they owe to the clearinghouse member. at which point the clearinghouse member has to cover and make sure that the losses that were uncovered by, say, a broker who's working through them are covered. Again, clearinghouse member goes bust, the clearinghouse has to handle this. If the clearinghouse runs out of money, we've all got problems. But this hasn't really happened.